In this video, we're going to talk about money. Now, money is something that we use every day, so everyone has experience with using money and spending money. In this video, we're going to talk a little bit about the history of money and some of the roles that money plays in economic activity that we may not think about. So first is the question, what is money? Money is any commodity or token that's generally acceptable as a means of payment. So in fact, lots of things can be money, and everything on this page at one time or another in one place or another has been money. And so lots of different things can be money or serve as money. Now, there's a number of characteristics that we look for in a money. The first of one is that we need money to be a medium of exchange, something that we can that helps us buy and sell goods or exchange goods with other people. The second role that money plays is that money is a unit of account. It enables us to, by having money, and it enables us to compare things that are different on some sort of a common basis. So money helps us simplify these comparisons. And the last thing that money helps us do is to store. It's a store of value. We may produce more in one period than we are going to consume, and so if we want to save for the future, money helps us do that. It helps us, store the value of economic production for some time in the future, for future uses. So these are all the things that money helps us do. Now, the history of money is a very interesting one. We often, today the money is printed and managed by the government, but this really wasn't always the case. And in fact, if we look at the history of money, we see that money is a social phenomenon. It wasn't really designed or created by anybody, but really came about as a byproduct of trade. And it went through an evolutionary process like many social phenomena. So this is an important thing for us to understand, that money came about as a byproduct of trade, and that money is really a social activity as much as it is anything else. And sure, it helps us with our economic activity and with trading and with buying things and saving and storing value. It plays all those roles for us. But the existence of money came about from social interactions, from as a byproduct of trade. And this means it wasn't originally created by a government, and it can exist without a government, or certainly without government control. So the money does not have to be controlled by the government in order to exist. In a competitive market, money will exist with or without government control. So let's try to look at again a little bit more at the history of money. So when people were first trading, they bartered. They exchanged one good for another. So if someone who raised cows wanted a pot, they might exchange a cow for a pot, or maybe a cow for 3 pots, depending, something to make the values equal. But barter is great, but it leaves a lot of opportunities for potential trades to be unrealized. First of all, there has to be a mutual coincidence of wants. If you want a pot, the guy who has pots or makes pots has to want cows, and if he does not want cows, let's say he's a vegetarian, then you're kind of out of luck. It's also true that many goods are not easily divided. Think about a cow. It may be worth a few $1,000s. It's hard to, if you were trying to make an exchange for something that was small or small in value, having a whole cow might not be the best way to do that. And then there are a lot of goods that are just too big or heavy or difficult to transport. So, they might be able to help you trade in one situation, but certainly not in a place that's far away from where you're at. And then there are some goods and services that are perishable. So if I have a perishable good, that might cause me problems because I have to get rid of it right away, and maybe I'm not in a position to trade right away, and so that adds some complications. So for all these reasons, barter is a great system. It enabled people to specialize in function and divide labor and trade, but it left a lot of. It wasn't efficient. It left a lot of opportunities for trade unrealized, and so we get to what we might call barter 2.0, which is indirect exchange. In this case, we have three people. A potter might want shoes, and he has pots to trade. The shoemaker has the shoes the potter wants, but does not want pots. He might want bread instead. So the potter has to be involved in indirect trade. He will trade the pots to the baker for bread, and then he'll trade the bread that he got from the baker for the pots to the person who makes shoes. And so this way, everybody can be happy. And so you can imagine that there was a lot of this indirect trade going on. I'm trading with one person not because I want what they have, but because the third person might want what they have, and that's kind of how indirect exchange works. And eventually, what happens is some goods in that process become money. There are some goods that that almost all people find useful or desirable. So if you have a good you can that everybody wants, or everybody finds useful, or everyone finds desirable, well, then you can always trade for that. And it helps if it's something that can be divided into smaller units. Maybe if it's easier to hold and transport, that's also great. And lastly, it's better if it doesn't spoil or lose value over time. So there are certain goods that meet these characteristics that everyone finds useful, that are easily dividable, that are easy to transport, and don't perish. So metals met those characteristics, better than other goods and services, and they became a common form of money. Things like gold and silver and platinum and bronze have all been money at different times. And you can trade them in their crude form. You could also, there were private coiners who would take metals and make coins out of them. They would make them so they had uniform weights, and they would stamp on them the weight that they had. And they would also provide some verification of authenticity, of purity, and of weight. They could verify, yes, this was gold. It's a 24 karat gold, and it weighs 1 ounce, something like that. And they could, stamp that on the coin, so the person who receives the coin would know that it was verified, and it is what the person says it was. And so we went from kind of indirect exchange to indirect exchange of metals, and then metals became coins. And so you can kind of see this as a slow process that's evolving, where each step is an improvement on the previous step, but it's certainly related to the previous step. And eventually we have banks start to arise. Banks solved additional problems in this system because metals were great, but they were heavy. They could be difficult to carry. There was a risk to holding all your money, all your coins, all your metals, because somebody could steal it or you could lose it. And then idle money didn't earn any interest. So if you weren't going to use it for a while, then you really you lost the opportunity to earn interest or profit by loaning it to somebody else. So banks stepped in, and they specialized in providing transfer and payment services. And they could also make loans and collect interest, on your behalf. So you could leave your money with them. They would make a loan to someone with your money if you didn't need it. They would specialize in that, in understanding their risks and dealing with the third party, so you didn't have to. And then you'd pay them a small amount of money, and then you'd get to also make some interest. So banks enabled savers to make interest. And so banks played an important role in the evolution of money. We can see that when people deposited metals, gold or silver or platinum with the bank, they might give them a paper receipt. These paper receipts eventually became transferable and tradable, and this is where paper money came from. So paper money is a form of representative money. We have a paper certificate that represents the actual thing of value that's being held. So instead of having to carry around the gold or coins, I can carry on something that's much lighter and much more transferable. And this would be a piece of paper money. This was issued by a bank here, and it says that it's holding $50 worth of gold coins. So whoever has that piece of paper money would be able to access or get the $50 in gold coins. So if I bought something for $50, I wouldn't have to go to the bank, get my gold, give it to someone else. I could just give them this piece of representative money, this piece of paper, which in effect did the same thing. And so representative money started out as private commodity money. This is private meaning that the bank that issued it was a private business in the private sector, and it was commodity money, meaning that there was some sort of commodity of value that the paper money was representing or in lieu of, like gold or silver or some other metal. And this one here is from the Winters National Bank of Dayton, Ohio. And whoever had that bill would be paid $50 in gold. And so this bill, it looks different than the money we have today, but it has some similarities to it. And this is money that was created and printed by a bank, and it was a private bank, and it was backed by commodities such as gold or silver. So it's private commodity money. Well, that went on for some time. Then the government also created money. Here, this is government commodity money. So instead of the private bank issuing the paper, it's a government bank that's issuing the paper. And this is a gold certificate, and it's also a commodity money. $50 in gold coin is payable to the bearer on demand, meaning that if you have this piece of paper, then you go to the government bank, you can get $50 of gold. Similar to if you had a private commodity money. So the government commodity money and the private commodity money functioned in a very similar way. Here's another example of government commodity money. Instead of being a gold certificate, this one is a silver certificate. So this is a $10 silver note payable in silver coin to the bearer on demand. It's a silver certificate. So there was different types of commodity money, some backed by gold, some backed by silver. Could be platinum, could be bronze, it could be other things. It was mostly gold and silver, but it could be any commodity, really. Now today, we have government fiat money. It's a bit different. This is money that was issued by the Federal Reserve Bank. It's a $10 bill by the United States of America, and you look at the text here, it says this note is legal tender for all debts, private and public. $10. But nowhere on here does it say that it's backed by anything of value. Certainly not by gold or silver or any other commodity. So this is what it means to be fiat money. It means there's nothing behind it. There's no commodity on which you can exchange the paper for. It's no longer representative money for some commodity that's being held against it. And as a matter of fact, there's nothing of value being held against it. And so, the question is, why does this work? Why do people take this? Well, it's a social convention. I'm willing to take this $10 from Carl, because I'm confident that when I go to spend the $10 with Bill, Bill will also accept it. Once I don't think Bill will accept it anymore, then you have a currency failure. But we've been, since 1971, in the United States, we've had a fiat money, a money that is not backed by any commodity, not backed by gold, silver, or really anything of value other than the promise of the United States government that it is money and it can be used to pay pay as legal tender and to pay debts. So if we take a step back again, we can see that we've evolved in the 1800s from an economy that was largely dominated by private money and private banking, where private banks would accept deposits of gold, silver, things like that, and then they would issue paper representative money, paper commodity money in lieu of those. And the banks would have vaults, they'd hold the gold and things like that. In the economy, people would trade the paper. If someone wanted to exchange the paper for the gold or silver or whatever commodity was backing it, they could do that. That was private money and private banking. In 1913, Congress passed the Federal Reserve Act and created the Federal Reserve Banks, which we call the Fed. This was the central bank of the United States, and in effect, what happened? This created this created federal control over the banking system. So before this time, the banks, there were laws that they had to follow, but they were largely private. After 1913, after the creation of the Federal Reserve Bank, they were under strict control of the banking system was under strict control of the Federal Reserve Bank. They would oversee the banks, make sure that they were following the laws, and were heavily involved in banking. In 1933, in the middle of the beginning of the Great Depression, there was an executive order by the president that nationalized gold. It was against the law to own gold. People had to turn in their gold, except for a gold ring or jewelry or something like that you can keep. But gold coinage or gold bars or gold of any significance or substance had to be turned into the government, and they would give you money in exchange for that. But in essence, we nationalized, in the process of doing this, we nationalized money in the United States, because if gold was what was backing the money, and gold could only be owned by the government, it couldn't be owned by the public. Well, then the government took over money. Money was nationalized. Now, when they did this, they used the gold to back money. You couldn't really exchange for it because you couldn't really own it, but there was some correlation between gold and money. So the money was still commodity money, albeit the Fed required only 40% gold reserves. So this allowed the Fed to increase the money supply during the Great Depression, which was one of the things that the government was trying to do to help the economy get back on its feet and improve the economy. But this was a major milestone in the evolution of money, certainly in the United States, but also in the world. So in 1913, the banking system was nationalized. In 1933, the money was nationalized. So now money and banking are really the providence of the government and the public sector. In 1944, at the end of World War II, there was a meeting in the hotel at the Mount Washington Hotel in Bretton Woods, New Hampshire. And at the meeting were all the monetary authorities from the various countries around the world. And they got together to try to come up with some sort of a monetary arrangement that would stabilize the world economy after World War II. You can see in the picture in the bottom there, the man in the center is John Maynard Keynes. That was really just 2 years before he had passed away, so he represented Britain, and he was at this conference. And they created what's called the Bretton Woods system, which existed from 1946 to 1971. In the Bretton Woods system, or the international monetary system that was created for post-World War II economy, all of the world's currencies exchanged to the US dollar at a fixed exchange rate. And the US government, the central bank of the United States, would back all the world's currencies with gold. So they created a fixed exchange rate between gold and the dollar at $35 per ounce. And then they created fixed exchange rates between the US dollar and all the other currencies for the countries that were participating in the monetary system, which was really everyone. And then the United States would essentially back all the world's currencies with gold. And the idea was that countries would maintain exchange rates with monetary policy. They would use their monetary policy to try to keep the set exchange rates that were agreed upon in place. This system didn't last too long. In a sense, it didn't work too well. Part of the reason is you're fixing prices between gold and the dollar, and then you're trying to keep the exchange rates fixed. I mean, so the prices of gold and the prices of currencies were fixed. We know that prices are supposed to fluctuate. They're the adjustment mechanism in market economies. And here's two important prices, the price of gold and the price of all currencies, which can't fluctuate. So this system kind of got out of whack pretty quickly. And by the 1960s, it was already starting to weaken. So in 1971, President Nixon closed the gold window. Basically, the United States would no longer back the world's currencies with gold. Currencies were allowed to float freely and use the market to determine the relative values between currencies and the prices and exchange rates between currencies. But not only do we not back the world's currencies with gold, we stopped backing the United States currency with gold. So now the dollar is a government fiat currency. There's nothing backing it up other than the good faith and credit of the United States. But there's no commodity, no gold, no silver, no other asset or metal backing up money. And this is the money that we've had since the 1970s. This was the last big change in the monetary framework. Now we have government money, and it's a fiat money. And so what happened? Well, one of the things that happened was that inflation soared. You can see inflation is the red line, right? It didn't happen right away, but it happened pretty quickly. Inflation soared. It went from in between 2% up to as high as 16 or 18%. And this is what you would expect when you have money that was backed by gold and money that's now not backed by gold. So it takes more dollars to buy things when they're not backed by gold than it takes to buy them when they are backed by gold. It's pretty straightforward. So we saw massive inflation in the 1970s. Now, when we saw high inflation and high unemployment, and remember back to the ADAS model and Keynes, we're not really supposed to have both high inflation and high unemployment. And as a matter of fact, we're not supposed to have employment in Keynes' system until we reach inflation, rather, in Keynes' system until we reach full employment. But in the 1970s, we had high inflation and high unemployment. We called it stagflation. So the standard explanation in the ADAS model, the major tool we have in macroeconomic theory, is that there was an oil shock. OPEC reduced oil production. creating a shortage of oil and gas. Oil and gas prices in the United States skyrocketed as a result. And because businesses all use oil and gas, um, either to make products directly or to energy to power plants and facilities or to ship products. It's it's a factor of production in just about every business. Well, when the price of a factor of production goes up, aggregate supply will decrease, and we'll be at a point with higher prices and less employment. And so that's the standard explanation for the stagflation of the 1970s, was that the shock of the oil price shock impacted the economy in a way where the cost of everybody's products went up. And as a result, we had a decrease in supply, an increase in inflation, and a decrease in employment. But there's another explanation. This is the monetarist explanation, and honestly, one I think that makes more sense. As we switched in the early 1970s from a commodity money to a fiat money, it significantly decreased the value of the US dollar. The dollar had less purchasing power on the world market to buy all goods, including oil, which is traded which is a global commodity, or a commodity that's traded in the world market. So more dollars were needed to purchase the same goods and services. We had to pay higher prices in order to get all products, including gas and oil, which was certainly an important product. And budgets, in that case, get reallocated. People, if they have to pay more for something, they reallocate budgets, and this will cause a decline in demand and a decline in economic activity. So there's another explanation other than the explanation in the ADAS model. We have an explanation using monetary theory, that we had more money. The value of the dollar went down. When the value of the dollar goes down, it takes more money to buy goods and services in markets, including oil. And so here we are today. Money in the United States today is a government fiat currency. This is both the notes and the coins that we know about. But it's also deposits at banks and other depository institutions. Now, there's a number of official measures of money, but the two most important ones that economists look at are M1 and M2. M1 is a narrower definition of money. It consists of all the currency, the notes and coins that we might have. It consists of traveler's checks and checking deposits owned by individuals and businesses. Now, this is, you can see, a little bit outdated, because traveler's checks are not really something that I think even exists anymore in an economy with an electronic information technology economy. The need for traveler's checks is not what it once was. I'm not sure they even really exist anymore. And the distinctions between checking accounts and savings accounts, which once were very significant in terms of the interest they paid and the amount of liquidity that was associated with them, is also not a distinction that has as much meaning anymore. So I say this only because I'm acknowledging that there's these definitions are maybe a little bit out of date, but they're still definitions that we use, and that were, you'll see why in a little bit. It makes okay sense. So M1 is the currency, traveler's checks, and checking deposits, the narrower definition of money. M2 is a broader definition of money. It includes all of the things in M1 plus savings deposits, money market mutual funds, and other time deposits. Time deposits are things like CDs. So the difference between M1 and M2 is liquidity. So you can see M1 is all the coins, all the currency, and demand deposits, which are checking accounts. A checking account, you technically can get the money out immediately if you desire. A savings account, the bank would give it to you immediately, but it's not really required by law or practice to give it to you immediately. So savings accounts are a little bit less liquid. Now, again, this is not as pertinent today as the market has changed, but this is kind of the idea behind M1 and M2. So M1 is the narrower definition, the more liquid things that I can make into money right away. M2 is some of the it includes M1 and then plus a number of other banking assets that are a little bit less liquid. CDs, you might not be able to get the money right away. Maybe you've committed to 3 months or 6 months or 9 months and that type of thing. And then the same thing goes with money market mutual funds and savings accounts. And so when we look at the monetary base in the United States, M1 is a little less than $4 trillion, 3.99, and M2 is a little bit more than $15 trillion. So M2 is about 4 times the size of M1. And what that means really is that if we look at, most of the money in the system is in the banking system, right? So M2 is all banking system stuff. M1 is mostly, coins and currency and a little bit of banking. So M1 is the amount of coins and currency in the system is much smaller than the amount of deposits and various things that people hold and have in the banking system. So this is M1 and M2, the narrower and the broader definition of money. And so getting back to our original idea about, money, everything in M1 is a means of payment, and therefore it's money. Paper money, coins, things in my checking account, I can write a check out and immediately use it to pay for goods and services. So they're very liquid. Now, some savings deposit, so some things in M2 are not really means of payments. If I have a CD, I can't really pay somebody with that, especially if it doesn't mature for another 3 months or 6 months. And so I may not be able to have access to that. So we consider it part of the broader definition of money, M2, but not part of the more narrow definition of money, which is M1. And so the difference being liquidity. Liquidity is, it describes how fast can I convert something into a means of payment with little loss of value. Things like cash, I can do that instantly. Physical assets, if I had an antique car, for example, that I kept in my garage and it was worth a lot of money. Well, it's an asset. I can convert it to money, but it will take me time. I've got to find a buyer and conduct a transaction and those kind of things. So that could take a week or a month or longer. And so, again, the difference between the narrower definitions of money and the broader definitions of money is the amount of liquidity that's associated with them. And so, again, going back to M1 is smaller in size, about a quarter of the total money supply, but it's very liquid. M2 is the broader definition. It's the larger amount of money, but it's less liquid when compared to M1. Now let's look at a few things. So when we look at deposits in banks are money. But the checks that we write are not money. Checks are just a way for us to access our money. It's just an instruction to a bank to transfer money from your account to another account. So we don't look as economists as checks as money. The funds that are in the bank that checks are being written against, that's considered money. Now, similarly, credit cards are not money. A credit card is a loan, and it gets repaid with money, but a credit card or credit balance is not money. It's a loan. And debit cards, similarly, are not money. Debit cards give you instant access to your money in accounts, but are not money. So the money, so coins and currency are obviously money. Deposits in banks are money. But these things that we use to access money, like debit cards and checks, are not money. They're just vehicles we use to access money. And credit cards are not money. That's just a loan that we're taking out. We can actually, we might have. In this day and age, you might have $5,000 in the bank, and you may have credit card balances of $20,000, right? So the money that you have on your credit card is a loan. It's not considered money. And then we get to digital currencies, Bitcoin. Now, Bitcoin is money. Bitcoin is a private fiat currency. It's private because it's not been created or managed or controlled by any government, and it's fiat because there's really nothing of value backing it. It's a fiat money, like just like the money that we have today, but it's a private fiat currency. Now, one of the values of Bitcoin is the fact that it's private. I think that provide people. Some of the interest in Bitcoin, some of the demand for Bitcoin is for people who want to have a money that's not really controlled by a government. If you look at the U.S. dollar, which is a fiat currency, and you look at the amount of debt that the United States government has amassed, there's some risk in holding dollars. There's some concern the value of the dollar would decline in the future. So Bitcoin provides an alternative, and it's not something that's controlled by a government. It's also the number of Bitcoins that are allowed to exist is finite. It's published. So these are reasons that Bitcoin might be interesting and value, but it can be used as a medium of exchange. It's a unit of account, and it is a store of value. So Bitcoin and other cryptocurrencies, not just Bitcoin, but really any of these cryptocurrencies are also money. It's just another money. And when some of the cryptocurrencies and digital currencies first came out, there was some question about would they work, would they last. I think at this point we're really seeing digital currencies continuing to grow. Now, part of this makes sense. We live in a digital world. We live in a digital economy, so it makes sense that we also that money would evolve, that money that would innovate, and also be in a digital form also. And so we see, lots of activity with Bitcoin and other cryptocurrencies. And then there's a lot of innovation. New currencies are trying to be created, and it's not clear where this will all end. Maybe Bitcoin will succeed, maybe it won't. Maybe another cryptocurrency will succeed, maybe it won't. Maybe the blockchain technology, which the current crypto coins are based on, will succeed. Maybe it won't. Maybe it'll be a different technology that we use to implement digital currencies. But I think it is clear that digital currencies are here to stay. What form they take in the future, we don't know. But I think that it's pretty clear that we will that we will be doing that the digital currencies are going to be here and here for a while as money.